All right, welcome back. Today, we're going to talk about a really interesting investment strategy. It's all about looking at those scary headlines, the ones about environmental risks, and seeing something else entirely, a predictable, really powerful economic driver. We're going to break down how you can actually capitalize on the huge and frankly, non-negotiable demand for protection that comes with it.
So let's just dive right in. I want to start with a big question for you. In today's market, where do you think the biggest risk is? I mean, for a lot of people, especially if you're in a place like Melbourne, it's not just the usual market ups and downs. No, it's that very real seasonal threat of high fire danger. It's a risk that's all over the news, and it literally shapes how people live. But here's the flip side. For us, thinking like investors, that exact same risk, well, that's where we see a massive opportunity. Because think about it. Wherever there's a predictable threat, you can bet there's a predictable, urgent need for a solution. And that need, that's our way in.
So why is this so important, especially right now? Well, because we are all fighting this number, 3.8%. That's the annual CPI. With inflation that high, any money you have just sitting around is losing its value. It's literally shrinking. So finding growth that beats inflation, that's not just a nice to have, it's an absolute necessity. And this strategy is all about finding that growth in a place you might not expect.
Okay, so this is really the central idea here. It's how that risk we talked about actually becomes a powerful economic driver. You see, the urgency that's created by threats like high fire danger, it creates this incredibly consistent, almost guaranteed demand for certain things. So let's break down exactly how to tap into that.
And that brings us to the first part of the strategy, what I'm calling the insurance shield. I mean, think about it. When people feel like they're in danger, what's the very first thing they do? They look for protection, right? And in the world of finance, that protection, that shield, is insurance. It's the private sector's immediate, almost instinctual response to risk.
And this really gets to the psychology of it all. We're not just talking about financial products here, policies and premiums. We're talking about a fundamental human need. When there's a real sense of danger in the air, people aren't just buying coverage for their house. They are literally buying peace of mind. And trust me, that's something they will absolutely pay for.
Okay, now this is where it gets really interesting because this is where the real money is often made. It's not always with the giant insurance companies themselves. It's with the platforms that connect those panicked customers to the insurers. I'm talking about the comparison sites. These guys are the profit engines. They absolutely thrive on that frantic search for coverage, and they act as this essential middleman, taking a nice little cut every single time.
And look, it goes way beyond just your standard home insurance. This demand has a ripple effect. It spreads out into all these other specific niches. You've got landlord insurance for rental properties in those high-risk areas. You've got business insurance. You even have public liability for companies that work in those zones. Every single one of these is another potential way to get investment exposure.
Okay, so that's the private sector piece. Now let's shift gears to the second part of this strategy, following the government's lead. And you could argue this play is even more predictable. Why? Because when a disaster happens, government spending isn't really a choice. It's basically mandatory. And that creates a demand you can pretty much count on.
Just take a look at this number, 17.1 times billion dollars. That is a massive long-term promise to build and maintain infrastructure. And yeah, sure, not every single dollar is for fire recovery, but a whole lot of it directly funds the exact companies we're talking about: construction, engineering, logistics, the sectors that are absolutely essential for both getting ready for disasters and for rebuilding after them.
And here it is, in black and white, straight from the federal budget itself, supporting the recovery and rebuild from natural disasters. See, this isn't just some politician's promise. This is proof that the funding is locked in. The government is basically legally and politically obligated to spend this money, which makes the demand for these services incredibly reliable.
So the big question is, how do you actually invest in an entire sector like infrastructure? I mean, you don't want to try and pick the one winning construction company, right? That's super risky. Well, the key tool here is something called an ETF, an exchange-traded fund. The easiest way to think about it is like a shopping basket. It holds a little bit of a bunch of different companies, all from that same sector. So with one simple purchase, you're buying a small piece of the entire industry.
All right, so we've talked about the what. Now let's get into the how. Because it's one thing to spot an opportunity, but it's another thing to actually execute the strategy smartly. And that means you have to be really focused on managing your risk.
And this really highlights the number one rule here. Don't bet it all on one horse. Seriously, if you pour your money into just one insurance company,
A single really bad event could completely wipe out their profits and your investment along with it. The much smarter play is to use an ETF to diversify. You spread your investment across the whole sector. That way, you're not betting on one company getting lucky, you're betting on the entire trend.
Now, here's a cool little hack for you, a way to get started without even using your own cash. You can actually generate your seed money from other financial offers. A lot of those comparison sites we talked about, they offer cash rewards, sometimes up to $500 tax-free, just for signing up for things you probably need anyway, like health insurance. So what do? You take that cash reward and you immediately put it to work in this investment strategy. It's basically free capital to get you started.
All right, let's pull this all together. The big takeaway here really is about looking at the world through a new lens. It's about seeing a big, scary public risk not just as a threat, but as the starting gun for a guaranteed financial reaction. What you're doing is systematically turning a public challenge into a private gain for your portfolio.
And this is the perfect way to frame it in your mind. You're not being cynical, you're not betting on a disaster. What you're actually doing is making a really smart bet on the guaranteed, massive financial preparation that has to happen. It's an inevitable response, and it's paid for by millions of people buying insurance and billions of dollars in government spending.
And that leaves us with one last thing to think about. Now that you have this framework, this way of looking for predictable risks that force a guaranteed financial response, where else could you apply it? What other big public risks out there might be hiding these same kinds of portfolio gains? Definitely something to chew on.